So the solution to this problem puts us in a very strong position when it comes to our ability to understand credit risk, especially credit losses. We're only doing credit losses for now. So let me then continue. So you already did that. We know that. And so there's two approaches to this. One is we can model the variables, and there's a way to do this in closed form, or the one that I propose, which is more intuitive, is more interesting. Helps us understand things better, is through simulation. We simulate a process with the characteristics given, which is what you did. You create two equally likely future credit states with for probabilities of 13 or 7%. It agrees with our assumptions. We create two equally likely future exposures of 15 and 5, also agrees with our assumptions. And then we calculate the expected loss with independence, which is just multiplying the expectations, or we calculate the expected loss with dependence by generating, in this case, the 4 scenarios, and then we get the answer. Of course, instead of 4, we could have done 4 million scenarios, and the answer would be different. But the point is to be able to tackle these problems. This is not the typical math problem where you have a single solution. Here is very much a function of how you model what you do. So I'm less interested in finding the solution than to finding a solution. So in that same spirit, I have another example here just to solidify what we learned yesterday, actually over all these days. This is an interesting problem because it highlights some of the other considerations for unexpected loss, expected and unexpected loss. So this the problem is a problem from the FRM exam. FRM is the Financial Risk Manager exam. It's an exam proposed by GARP, the Global Association of Risk Professionals. I was a collaborator of them for a while. And this is an exam from very early on when I was involved with them. I haven't been involved with them for a while now. But here's how the question goes. And this is something that I encourage you to undertake. I'm not going to do it as a homework assignment. I'm going to just show you how we do this. I want you to see how it's done so that we can solidify some of these new concepts that we're introducing in this course. And this problem talks about 10 bonds, 10 B rated bonds, 10 million each, so $100 million bond portfolio. Assumes a 1-year probability of default of 6% and a recovery rate of 40%. That means in the case of default, you recover 40%. So slightly below average. What's the expected loss? So the expected loss is, the only difficulty here is to not multiply by 40%. It's just the multiplication of expectations. We're not going to multiply it by 40% because that's the recovery rate. We have to take into account the loss given default, and the loss given default is going to be 60%. So that means that the answer is 60% for the recovery, 6% for the probability of default, and 100 million for the exposure. The answer is $3.6 million. That's the expected loss. And this is a problem in this exam, not very hard, something that everybody can do. We can express this number in different ways, which is that the expected loss is about 3.6% of the notional value of each bond. Okay, all right. Now, so this is the exam given, but I have a version of this problem which I like and I find more interesting, which is to do the same for not the expected loss, but for the unexpected loss. And I remind you, the unexpected loss with the standard deviation as a caricature of the credit VAR. Okay, so as you are seeing in the theory of credit risk is so hard that almost everything you want to do has a simplified version, because the real thing is typically very difficult. I assume you will be taking courses on credit risk in this program, and then you will see that just everything is complicated. So with that comes the simpler version of everything. And in this case, the unexpected loss, I like to think of them as the variance, the volatility. In practical situations, the credit varies where it's done, and if you have to do this in a professional environment, like in a bank, you will see that it's done in a very particular, precise manner. But for us, we're going to take a lot of freedom because, especially with things like this, problems like this, we can develop our intuition better if we work with something like the standard deviation. So we're going to we want to calculate the unexpected loss. It's the same assumptions as before, but when we deal with the unexpected loss, I need to make assumptions about the dependent structure of my bonds. So I have three assumptions here. So we're going to do this problem from three perspectives. One is the issuer is the same. If these 10 bonds are issued by the same company, if it's the same issuer, it's going to have a certain unexpected risk or a certain standard deviation. If they're independent, it'll be different. Or if the correlation between the issuers is like 50%, somewhere in between, like for example, if they're in the same sector, then that again will give us a different answer. So let me show you how to think about this. And to think about this, I'm going to start with the easy one. Then I'm going to go to the second easy one, which is B. And then I'll do the full generality one, which is C. Of course, if you do the full generality one, which I will do for any correlation number, the correlation could be 1 or 0. So I could go right into the answer for C, and then A and B would be particular cases. But I don't want to do that. I don't want to do that because I want to make sure that you get the intuition. Again, all of these things that we're doing is about getting the intuition. It's not about getting the problem done. So when it comes to the intuition, I want you to think of case A. In case A, what are we doing? In case A, we are doing 10 bonds issued by the same company. So they're essentially the same bond. If one defaults, they all default. It's the same bond. So to calculate the standard deviation for that, we really have one event, which is either the company defaults or it does not default. So it's the standard deviation with a very simple random variable, one that has it's essentially a coin flip with a probability of 6% of default. So in the case of A, the loss distribution is a random variable with only two states: default with a loss of 60 million after recovery. I'll remind you, recovery was 40%, so the loss given default is 60. Or no default. The first event has a probability of 6%, the other has a probability of 94%. So the expectation of these losses is $3.6 million. And to calculate the variance, we take the difference between the expectation, which is 3.6, and the 3.6 we did in the previous problem, right? And then in the first event, I have 60 million as the loss. In the second event, I have $0 as the loss. The first event comes with a 6% probability. The second event comes with a 94% probability. So I look at the difference squared, and that gives me the variance. So the variance is 200 with a very strange unit, which is dollar squared million. That's the unit. Okay, that's the variance. So if that's the variance, then the unexpected loss or the standard deviation is therefore the square root of that, which is about $14 million. All right, what does that mean? So we got the answers, $14 million, more or less. I mean, I know that you will be calculating the square root of 200 in a more careful way than I did, but it doesn't matter, the answer is important. What does this mean? So we got the answer, but what does the answer mean? That means that although the expected loss is 3.6 million, not very high, there is a non-unreasonable, there's a reasonable probability of losses which are much bigger than that, $14 million bigger than that. As you know, the standard deviation measures the distance to what might happen. And what might happen, standard deviation is about, with a probability of about 60%, right? If you have a Gaussian, this is not a Gaussian, but if you had a Gaussian, the standard deviation is about 60% distance from the mean. 60% probability of losses away from the mean. That means that these things are to be expected. So although of $100 million, 3.6 is a small number, 3%, the standard deviation is quite high, it's 14 million. And that means there is more than a 50% chance you will be losing 14 plus 3.6, almost $20 million. That's the meaning of this. Okay, so this is a fairly risky portfolio. And it's not because the expectation is high, it's only 3%. The unexpected loss is very high. That's how we think about that. Okay, all right, but we got the calculation done. What's the purpose of this problem? Let me look to the case B, where these defaults are independent of each other. If the defaults are independent of each other, then the loss distribution, we think of it as a sum of two independent random variables. Each of them has two states, a default of 6 million after recovery or a no default with a loss of 0, but they're independent. And when you have a sum of independent random variables, we know what happens to the standard deviation, which is that it grows only like the square root of the number of variables, only the square root of 10. Okay, so the standard deviation is, for each of them, is 1.4. It's exactly the same number we got earlier, divided by 10 because we have, it's 1 in 10 bonds, so 1.4 as opposed to 14. So we have 10 random variables. Each of them has an expectation of $360,000, and each of them has a standard deviation of $1.4 million. So what's the standard deviation of the sum of all these 10 random variables if they are independent? So it's the square root of 10 times $1.4 million, or about $5 million. Right? So that's the second easy one. And now let me do the one in general. The one in general is, what if I assume that the correlation is just a number, rho, okay? I'm dealing with a sum of 10 random variables. Each of them has two states of 6 million of loss after recovery or a no loss in the case of default with probability of 94%. The expectation of each is 36, the standard deviation of each is 1.4, and the correlation is a number. It's a number which as you can see here, I am going to develop the variance of my portfolio, as we have done many times in the past, as the expectation of the sum of the expectation of the product minus the product of the expectations. This is something that can be expanded into the diagonal and off-diagonal terms. The diagonal terms are known because they involve the individual standard deviation, which we have here. I'll put this with a different color. Okay, so these are known, these are here. And these ones are these where this number here is the correlation between the losses. So I have to use a math formula. It's a math formula we have seen so many times now. We saw it in the context of risk matrix. We saw it in the context of portfolio volatility when we studied investments. It keeps coming up, okay? And it comes up here again. So everything here is now known. We know that term, we know that term, or we know these terms. So we just do the multiplication of everything. And the result is that the variance of this portfolio is $110 million squared So the square root of that is 10.5. So we had 14, we had about 5, and then we have about 10.5. This is for correlation equal to 1, correlation 0, correlation 0.5. Okay, so this is the summary of the 3 cases that we have done. Intuitively, very clear. When correlation is 0, we get the lowest risk, the lowest unexpected loss, then that one, and then of course that one. Mathematically, you could consider cases where the correlation is negative. That's very hard to imagine in a practical situation, that the default of one bond implies a credit upgrade of another one. I mean, you could come up with some very weird business scenario in which that would be the case, but mathematically...
Default swaps, right?
Sorry, well, yes, it could be. It could be. Although, yes, that would be a slightly different issue, but you understand. We understand what we're dealing with here, right? So mathematically, this thing is, I think we're in command of the mathematics of these types of problems, which was my intention. And as you can see, this is something which allows us to see the universality of some of these probability distributions and the way to deal with probability distributions. So here again, we see more reasons to develop a skill set that helps us deal with probability distributions. Well, I have another problem here, another example. It talks about this is also another problem from a professional exam. It says, which loan is more risky? Assume that the obligors are rated the same, are from the same industry, and have more or less the same sized idiosyncratic risk. So there's a loan of $1 million with 50% recovery rate, a loan of $1 million with no collateral, a loan of $4 million with 40% recovery rate, or a loan of $4 million with 60% recovery rate. So what would the solution be? I allow you to think about this and give you 1 minute to tell me. You probably don't need a minute.
With the highest recovery, D.
Do you think that's the more risky loan?
Oh, the risky. Okay. The risky would be 1 million, or 4 million with the 40% recovery rate. Or no, B with no collateral. Sorry.
Is that what you think? Is that your final answer? This is really an exam question, an English exam, more than anything. Go through the questions with a bit more carefully. Okay, the difficulty here is to understand exactly what the question is asking. Let's do the expected exposures. Okay, in the first one is $500,000. The second one is 1 million because there's no collateral. This one is 2.4. This one is 1.6. So the answer is C.
C, yeah.
Right. So although it has high recovery, of course, it's a bigger loan, it's a bigger portfolio. So, all right. So what do we learn here? What we learn here is that the mathematical calculation is one challenge, but the conceptual understanding of what we are doing is another challenge. All right. Let me now then move to a credit trade, and I'm going to do this however long it takes. It may take me over the 1 hour for the break. It doesn't matter. This is a credit trade, which is perhaps one of the most important things that we're doing today. Perhaps the most important thing. I think we're ready for this. And now this is a bond that I'm going to consider. It's a bond issued by a default prone party that has a 6%, the next statement, has a 70% annual probability of default. And this is in a Markovian way, which is that it's 7% every year. So the probability of default between now and next year is 7%. The probability of default between next year and the year after, conditional that is solvent on next year, is also 7%. So it's in a Markovian way, it's always 7%. Now we understand this. We know that what that means. We assume no recovery, so a default will be zero. There's no recourse to this bond, and this is a very simple bond, very weird bond that only contains two $5 coupons, no principal, and the coupons will happen at the end of years 2 and 4. So it's a 4-year bond. Okay, so we picture that we are going to give someone $10, and this someone will give us $5 in 2 years, and another $5 in another 2 years. We assume 0% interest rates. If we assume zero recovery, the price will be $10. But of course, now when we hear that it has a 7% probability of default, we're going to offer less than $10. And that's what I want to get at. I want to understand how much are we willing to pay for this bond. I'm not going to ask you for the answer because we don't have enough information. So we haven't seen some of the considerations that we need to take into account to do this problem. So I'm just going to walk you through it. And I'm going to do this in a fairly practical way so that we understand what we're doing. All right, so we're going to make a few assumptions. We're going to assume that our counterparty maintains risk capital to cover the standard deviation of losses. In fact, we're going to assume that we're going to be regulated. So we assume that we are a bank. We're a regulated bank. And we're going to keep collateral. This is what we call regulatory capital. We called that 2 days ago. Regulatory capital is going to be equal to 2 standard deviation. So the standard deviation of losses times 2. As you know, the standard deviation times 2 is conceptually like a 90-some% confidence interval. So it's going to be 2 standard deviations. That's what we're going to do. And we're going to adjust that annually. Why? Because we also saw 2 days ago that as a coupon payment is paid, then my risk profile will drop. So my risk profile, as we will see, is highest at the time that the bond is issued, but then it drops. And if it drops, that means that we get some of that back. In other words, we're going to do this. We're going to do an annual adjustment to the risk profile. Okay. In practice, when we do this daily, banks do this exercise daily. Every day they calculate this thing. We're not going to do it daily. We're going to do it annually. We have 4 years to do this. We have payments occurring in 2 years. So this problem is very manageable to put on a piece of paper without having to do very sophisticated calculations. And finally, we're going to make it very realistic. And this I'll explain when we're there. I'm going to assume that we demand a certain risk capital, a certain return on risk capital. In other words, we don't like to just trade for free. We're not trading just to get our money back. We're going to trade to make a profit. And that will introduce additional considerations. And let me advance you something. At the end of this credit trade, we will not only understand certain things about credit risk, but we will also understand how the financial markets work and how the different participants work. In particular, I'm going to introduce a concept which I'm going to develop in detail in the future, which is the concept of an asset manager. In particular, in this case, a hedge fund. You will see. And then suddenly the financial industry is going to arise in our feet just because of this particular problem that we're addressing. Okay, so just bear with me. There's a lot to gain from this seemingly simple problem. The problem is simple because I want us to be in complete control of every aspect of this trade. And then we will be able to understand how the financial system works. Okay, now that's my promise. To deliver on that promise, I need to do something a little bit boring first. I need to do what's called the tree of survival and default probabilities. This is something which you all know how to do. You've done it many times. I have it done here for you, and I'll explain to you what it is. So right now I am at time 0, where the probability of survival of my counterparty is 1. My counterparty is not on default. If my counterparty was on default, I would not do the trade for sure, right? But so right now the probability of survival of my company is 1. That's why this number 1 is there. I'm going to walk you through this. So that's the probability of survival, okay? Survival probabilities. And I will also do the default. I'll do both at the same time. So the probability of survival is 0. If I think of a year ahead, the probability of survival is 93%, is 1 minus P. I remind you, P was 0.7, which is here, okay? So the probability of default, so this is, as you can see here, this is default. And this is no default. Okay? Right. So right now, a year forward, I have a 93% probability of survival and a 7% probability of default. That's in the first year. In the second year, that probability is 7%. That means that from today, the probability of survival is 86.5%. And the probability of default in the second year is 6.51%. Why? Because to default on the second year, I need to survive. I want to have to survive the first year and then default on the second year. That is that's 6.51%. Okay, and so on and so forth. The probability of survival to my third year is 80%. Probability of default in my third year is 6%. And then finally, the probability of survival all through the life of the bond is 74.81%. And the probability of default on the last year is 5.63%. So these are all the probabilities that are relevant. There's nothing else to be done. This gives us everything. And we realize that this has to do only with my counterparty, has nothing to do with my bond, and has nothing to do with capital structure. We already agreed that the recovery rate is going to be 0 if there is default. Okay, so we got that. These are numbers which I'm going to be using throughout my calculation. It's going to be very cumbersome to come back to these numbers, but every number that I will be using going forward comes from these 3, okay? So if you are doing this on your own, you would just have to come back to the 3 like I did, get the number, and move on. Okay, so let me start now with the consideration of expected loss. And there's 2 methods to do this. The first method that I'm going to do is I'm going to look at the expected cash flow. So I have a bond that is going to be paid on year 2. So I have to multiply the expected. So to calculate the expected cash flow, I need to multiply the payment, $5, which is fixed, times the probability of no default in the first 2 years, which we already calculated. This in the previous 3. And then I add the second bond times the probability of no default in the first 4 years. If there is no default in the first 4 years, then I collect both payments. And the answer to that, if you just get the numbers that we developed earlier, is $8.06.5. So anybody can do this. It's just a very simple multiplication because we already have the numbers that we got from the survival tree in the previous slide. So my expected cash flows are $8.06.5. And that's the definition of my probability of default, which means that the expected loss is $1.93.5. That's easy. There's nothing wrong here. Okay, great. Now for the method 2, I'm going to do something a little surprising. What I'm going to do is I'm going to calculate the exposure of my bond in each of those periods of time, in each of those years. The exposure in year 1 is $10. The exposure in year 2 is also $10. I haven't been paid anything. But the minute I get my first coupon payment, my exposure drops to 5 for years 3 and 4. And now what I want to do is I want to calculate the expected loss by multiplying the exposures times the probability of default in those particular years. Okay, so the exposure in year 1 is $10 multiplied by the probability of default in year 1, which we have in the previous 3, plus the second exposure times the probability of default in the second year, which we had in the previous 2, times exposure number 3, which has dropped, times the probability of default in the third year, plus exposure in the fourth year, times the probability of default in the fourth year, which we also had in the previous 3. You take all the numbers and you get exactly the same result. So this is 2 ways of calculating the expected loss. Great. And this is not hard. But now comes the question. I want all of you to put yourselves in the position of the trader. So you're not the issuer. The issuer is whichever company is issuing this. You're not going to be in that position. You're going to be the one that's going to buy this bond. With this calculation we have just done, how much are you willing to pay for this bond? That's what I want us to think about now. For sure, we're not going to pay more than $8.06.5. That's there we lose on average. We don't want that. Okay, so the answer is going to be we're going to pay $8.06.5 or less. How do we determine how much we pay for this? Okay, so to do that, what we need to do now is think in the following way. We're going to think in the following way. We are taking a risk by buying this bond. So definitely, we are going to have to take into consideration the fact that if we paid $8.06.5, we're taking risk for free. And now, from that perspective, we need to understand the price of risk. And we need to understand the risk we're taking. We need to understand both things. So let me look at the risk we're taking first. Let's understand what is the risk we are taking. And for that, I need to look at the unexpected loss. So let me go to the unexpected loss. Only then we'll understand the risk we are taking, and only then we can start to think how much we're willing to pay for this. So to calculate the unexpected loss, I'm going to calculate the standard deviation of losses in each of those years. So I have the numbers here. I don't need you to, you know how to calculate standard deviations. That's what I have done here. These are the variances. Okay. I don't need to go through this. You already know how to do calculations of variances. These are very simple for new use. So I'm going to summarize all of that for you as follows. Every year, I have a certain standard deviation of losses. And this is how we define our unexpected losses earlier. Okay, so let me continue. So in year 1, the standard deviation, which would be the square root of 2, sorry, it's the square root of that number, and the square root of that number, and the square root of that number, and the square root of that number. Okay, that's what we're doing. So this gives us the standard deviation of losses per year. So at least now we understand the risk that we are taking, and the risk is changing from year to year. Obviously, the risk goes down when we receive the first coupon payment. But what we don't know is how to price risk. And now I need to make a connection between this and the very first lecture that I taught. In the very first lecture, we already were confronted, that's what we were looking at investments. We were already confronted with how to balance risk and return, how to balance risk and profitability. This is exactly the same problem in a different context, completely different context. Okay? How to balance risk and premium, the premium for the risk. There, we're resolving it in one way. Here, we're going to resolve it in a different way. But this is a universal problem when you're doing finance. How do you balance risk and return? So in this case, what I'm going to do is I want to make it easy on ourselves. And I'm going to assume that we are a bank now. We are going to assume that I am regulated as a bank, and therefore I have credit reserves and economic capital. So we explained this in a previous lecture. Let's see how that looks in this particular trade. So in this particular trade, I'm going to assume that I have a risk capital of 2 standard deviations, as I mentioned earlier. That's about a 97%, 99% confidence interval for my value at risk, my credit value risk, for example. So I'm not using value at risk, I'm using standard deviations, which is easier. And then I'm going to assume that I have to put up capital, which is like that. So that means that I have to put up capital, which is $5.10 in year 0. And if you don't know where this is coming from, remember that in the previous slide, I gave you the standard deviations per year. And in year 1, it was $2.60. So that times 2 is $5.10. So this is 2 times the standard deviation number that we saw earlier, okay? And at the end of the first year, if your counterparty is still solvent, the probability, the risk has come down a little bit. The standard deviation dropped. So you have to maintain a risk capital of $4.93, which means that at the end of year 1, you are returned 17 cents of your risk capital. At the end of year 2, you're going to be returned more than $2 of risk capital. And at the beginning of year 4, you're going to be returned just a few cents. And of course, all of that will get back to you if there's no default at the end of the life of this bond. So this is how economic capital works. This is how regulatory capital works. So in this case, what we have is, I remind you, we have 2 things. A credit reserve, which is going to be the $1 and which was the expected loss. And this is the economic capital, which is the unexpected loss. A credit reserve is there to make up for losses that may come up, and the economic capital is there to make up for the unexpected losses that may come up. Okay, so that is what you have to put up as economic capital. You're a bank, okay? You're a regulated bank. So we are a regulated bank. You were a regulated bank, and now imagine that now I impose a 10% target for return on my cost of capital. That means that all of these numbers represent an actual cost, an accounting cost to me of $1.47. This is a risk capital accounting. Which means that this is an additional cost. So if my expected loss was $1.90, I have to add $1.47 to it, which means that now, if my math is right, the total cost of buying this bond to us as a bank is over $3. Almost $3.50. That means that we're not going to pay more than, say, $6.50. That's how much we're willing to pay. We pay more than that, we lose money. Okay. Now, let me ask you a question. Imagine you're not a bank. Imagine you're a hedge fund. Hedge funds have the characteristic that they are not regulated, so they don't have to put up any risk capital. They're taking risks, but they calculate at what price they take risks. So if you're a hedge fund, how much are you willing to pay?
Probably 6.5, no?
Well, at 6.5, you're competing with the bank. But for example, if you offer 7,
6, yeah.
right? If you offer 7, then the bank cannot compete with you. And
I make a profit.
And you make a profit. Right? And you know what? This is a good caricature of how things happen in practice. In fact, many hedge fund managers, they have been working at a bank and they know these things. They know how far banks can go because banks are regulated and they're not. Unregulated companies like banks, or even if you're a pension and you're regulated just differently from a bank, because it's your own money and you don't pose a systemic risk to the system, then you can be more aggressive when it comes to how much you can offer. Okay? And if on top of that consideration we have here, you add taxes, let's say you're a taxable entity, let's say you're a non-taxable entity, pension plans are not taxable, banks are taxable, then tax into this another considerations to this. And this is a very interesting way to see, on the one hand, how price formation happens when you take into account not just market risk, but also regulation and maybe tax considerations. And different players are regulated differently, both from a fiscal as well as from a risk perspective. So the financial system is now then full of participants with different characteristics, and they all compete with each other with things like this. And it's very interesting that at the end of the day, the mathematics is there to give you a good framework to understand all of these things. But what will make you competitive is your own position when it comes to risk management and fiscal policy. Okay, so I think this is a good example that helps us understand these things from that perspective. Okay, it's very all right, good. So I think you should feel powerful because we haven't really learned anything new. Everything we have seen here we already knew. You knew how to do probabilities, you knew how to do expected cash flows and this and that. But a reflection on the power of economic capital gives us, I think, perhaps a newfound perspective on how financial systems work, and perhaps also helps us understand competitiveness in the financial sector. Okay, I know it's all throughout. That's what math does for us. Okay, so let's take a 10-minute break now, because it's also we need to celebrate that we understood how financial markets work. We're going to take a 10-minute break now, and we'll come back. And when we come back, I'll tell you about the commercial credit models. So I'm going to now talk about credit matrix. I remind you that this has already come up. When we saw the history of risk management, we saw this is the sequence of events. 1987 was the one-day market crash of the S&P, 25% in one day. That led to the Basel resolutions of 1991, the Basel Treaty. It gave rise to the risk matrix methodology created in 1994 that regulated or was aimed at market risk, and we have seen all of that now. And then I mentioned that JP Morgan proposed a methodology in 1997 called credit matrix as an attempt to regulate credit risk. And that was adopted in Basel II around the year 2000. And what I'm going to see now, what I want to show you now is how this was done. It's going to be a very simple summary, maybe half an hour or so, just an introduction to this. But the context is this is a development done by a bank, adopted by the regulators, and now used worldwide, still today, despite it's very old, to do some of the things that we have been explaining when it comes to credit. Okay, so up until now, we have seen credit as something that's triggered by defaults. The change here in credit matrix is that credit losses will not happen only because of defaults. They will happen every time there's a credit migration. So if you have a bond and your counterparty has a credit downgrade, then that creates a loss. This is a methodology that is aiming to understand losses, not gains. In other words, if you have a bond with your counterparty and the counterparty is upgraded, then your bond is now worth more. But this is not our aim with this methodology, okay? And the credit migrations are going to be obtained through a matrix of migration probabilities that we have already seen in a previous lecture. So the context for this has been set up for us. We saw that the credit rating agencies operate in this framework, so it's something which has been already developed in this course. And each instrument is going to be valued using the credit spread for each rating class. Now, it's very important to mention one very important observation here is that credit matrix is not going to reprice the instrument if market conditions are different. We're only going to take credit as an input to market the instrument. For example, in our previous example, if interest rates went from 0 to 10%, the value of the bond would decrease. But this is not a loss that is considered under this methodology. Okay, only credit events create that. And recovery rates are not really modeled. They're going to be obtained from historical similarities. So essentially, we take them to be constant. Now, the default correlation that we've already seen earlier in this lecture today play a big role when it comes to credit risk. They're going to be done in a very particular way. I will show you how that's done in a few minutes. Okay, let me just advance you that it's going to be done through a database that is provided by these are all commercial methodologies. They're going to be provided by the commercial vendor, whether it's a credit matrix or a different one. I'll show you how that works. I have one example that I've done for you where we will understand how this is done. And as I mentioned earlier, it does not integrate market risk and credit risk. Credit is just left on its own. All right, so to do that, I have here I'm going to develop this in a particular case, not in abstract contexts. I prefer to do it with a particular case. And I'm going to consider the case of a bond, a BBB rated bond. Think of it as Goodrich, for example. And this is a bond that has a certain value today. The value is caused by interest rates. I have a value today of $107.55. That's the value of my BBB rated bond. And I can see, if I look at the value column, I can see that if my counterparty was rated differently, the value of this bond would be different. A defaulted bond in this case is about 50%, which is what we've already discussed, is the average recovery rate. If it's just above default, the bond is valued at $83.64. And if my counterparty was rated top class, AAA, then the value of the bond will be $109.37. So these are the values that we have for the bond today if my counterparty was rated differently. But also, and this is the key to the credit metrics methodology, this is the value we're going to take for the bond, say, a year from now, if my same counterparty gets upgraded or downgraded. In other words, this is not only a statement of the value of the bond now, this also says that if my counterparty gets upgraded to AAA in a year, that bond will go up in price to $109.37. And it tells me that there's a 2% probability of that happening. So in this column here, we have the probability, what's called the migration probability, is the probability that my counterparty changes from one credit rating to another. The most likely one is that it stays at BBB. There's an 86.93% chance of that, but it could default. There's an 80% chance of default. And in case of default, my bond is going to be worth $51.13. So this is the information which is captured in the financial markets, my rating, my probability of transition given by the commercial model, and the value of my bond. And what I have on the right here, is some mathematical calculations of the quantities that matter, which are going to be important for us to develop these theories. On this column, what I have is the components of the expected value of my bond. You can see that the expected value of the expectations times the value of my bond here is $93.49. The expectation of my bond, in the case that it gets upgraded, is 2 cents, because it's very unlikely it's going to get upgraded, although the value is going to go up. And here what I have is the probability of default times the default value of the bond, which is that. So, which is 9 cents. So these are the components of this expression, which, as you can see, is the expected value of my bond next year. And in the last column, what I have is the standard deviation. In fact, the variance of the value of my bond next year, taking into account these future values and the mean. The mean is obtained from this. So this will give me the mean. The mean goes there. Okay? So this is the spreadsheet that summarizes the credit considerations for this particular bond. So far, there is no methodology here. This is just a reflection of the market conditions for this bond. So I'm going to consider the events that matter for a risk calculation. I see that there's an 80% chance of default that's going to create a loss of $56.42. That's the difference between these two values. Then I see there is a 30% chance of a loss of $23.91, which is the difference between these values. Sorry, not these ones. These values. And that's 30% chance. Okay. So these are the cumulative probabilities, as you can see. Okay. So I am doing this because I'm aiming to calculate a quantile of the losses. I'm aiming to calculate the credit value at risk. So with this, I can see that there's a 1.47% chance of losing $9.45 or more. And then that gives me this cumulative loss distribution function. Okay, I have a low probability of losing a lot, and I have a high probability of losing a little bit. So my 56 is here. And this one is here. All right, so this represents my loss cumulative distribution function. If I put this in the context of what we did earlier, when I introduced the quantile will be 1 minus this, so it will look like that. Okay, but it's really the same curve. It's really the same curve. Okay, so from here, what we learned is that our worst credit loss at a 95% confidence interval is about $10. We don't have exactly 10 here. 10 is right in between. So we're going to have to either interpolate or figure out a way to do that more or less accurately. This is not something that I want to spend time on. It's not relevant. Okay, but from here, it's reasonable to say that the 95% worst credit loss is about $10. See that, right? And it's reasonable to say that the 99% worst credit loss is about $20. That comes from here. It's going to be by that I mean it's about $20. So you see, this is 30%. You want it to be, and this is 1.4. So you want something in between. Well, I say it's $20. And again, these are just approximations that I'm doing, so I can address this particular example here. So this is the way we're going to be doing the risk analysis according to the credit matrix methodology. Okay. Now, this gives us the expected loss and the unexpected loss in the case of a single counterparty. If I'm going to consider now more than one counterparty, as we saw in the previous lecture, we're going to have to understand the dependent structure between counterparties. And in this case, this is done through correlations, through default correlations. And I'm going to show how this is done to you with one example. I'm not going to give you the general methodology. I'm just going to do one example. So imagine I have two counterparties, which I'm taking to be DuPont and Allianz. DuPont is the United States plastics manufacturer, and Allianz is the German insurance company. So let's say that these two are in my portfolio, and let's say that each of these has certain default characteristics, and I want to understand how the default correlation between a DuPont and an Allianz works. Now, this thing I want to tell you is something very similar to a cooking recipe. You don't know why it works, you just follow it and then just be done with it. Okay, there's no mathematical explanation why this is the right thing. It's just an algorithm that is proposed by them. It works, it can be programmed, and it gives you an answer. But I have no way of telling you why this is true. This is perhaps the first time in this course that I have to tell you something that I cannot justify. There's no way to justify this. I'm just telling you what this does. And to do this, there is a companion that comes from with this commercial credit risk model, which is in addition to the transition probability matrix and in addition to the rating of my counterparties, I am given a database. I'm given a database that contains time series for 152 country indices. These are country sector indices. These are country sovereign indices. So in other words, these 28 indices represent countries. These 152 indices represent sectors within countries. Okay, one is for the country, the other is for the companies in the country. And then I have 19 worldwide indices. And in particular, in this database of approximately 200 time series, what I have in this 200 time series is a time series for something called the US Chemical Index, something called German Insurance Index, and something called German Banking Index. And these are time series, okay? What is in this time series? We don't care. We're given time series that have this heading. This is part of the mystery of this model. And now what we're asked to do is we're asked to do the following. We're asked to do a linear regression between the stock price of each of my two counterparties, DuPont and Allianz, with these indices given, with this database given, and in particular I selected these three which are relevant for what I'm explaining. This is just for explanation purposes for you today. And then what I see is I'm asked to do this, and when I do linear regression, these are the results that I obtain. For the case of DuPont, which is R1, what I get is that DuPont has a beta of 90% to the US chemical index. And again, these are indices made for the purpose of default. They are not stock indices, okay? They're just default indices, whatever that may mean. I cannot explain. This is just the methodology. So it's 90% of the US chemical index, and that's an error. That's for DuPont. And then for Allianz, what I have is I get a beta of 74 to the US, to the German insurance index, and I get a 15% beta to the German banking index. Why? Because this is what linear regression tells me. And in the linear regression, one of the variables is the Allianz stock price, known. The other one is this database, this time series given to us that we have no understanding of. And then an error term. Good. So with these betas that we have obtained from this linear regression exercise, which is part of the prescription of this method, I have no mathematical explanation why this has any meaning. From that, what I do is I do another recipe to say that the default correlation between DuPont and Allianz is given by the following expression. Is given by the product of the betas times a number also provided to me, which is a correlation between these two indices. And again, I cannot explain. This is just the way this algorithm works. The product of these betas times the default correlation between these two other indices. You just look up these numbers, and the answer is 11%. And that's the number you use. There's no math here. It's just a recipe. It's just an algorithm. You implement it, and that is what creditmetrics will do for you. We would assume, or we can say, we will presume, we will hope that all these databases given to us have been designed so that the results that I get when I run this algorithm are as close as possible to the reality, whatever reality may mean. We're living in the world of make-believe. Okay, so this is the way these things are done. It is perhaps a reflection of the fact that credit matrix and credit analysis in general is very hard. We're not at the point where we can really understand these things very well. I'm just going through the algorithm. And these are things which rely on commercial methodologies. They're not financial. I still chose to show them to you because in the complexity of credit markets and how we want to understand how they work, sometimes you just have to resort to things like this. So here there is no, how can I say, intellectuality whatsoever in these numbers. Okay, all right. Now, once you have the correlations of course is not a solution to everything, but now once you have the correlations, what you can do is you can go to a simulation methodology. And if you have a portfolio that consists of M counterparties and N possible credit states, think of N as 8, think of M as, say, 1,000, if you have 1,000 clients, okay? Then what we do is we need to simulate a total of N to the M states. That's how many situations I can have my M counterparties as a result of 8 different states or N different states. Now, just to give you an idea, this number is about, in this particular case, is 8 to the power 1,000. This is big. Very big. I'll come back to how big it is. Okay. So I'm just this is destroying this. So then we're going to calculate this multivariate distribution. And in the multivariate distribution, what I have is the marginals, which we did in the first example. So I can do each of these counterparties one at a time. And then with the correlations, I put it all together into a very big simulation machine. And now this is the thing, because I'm dealing with such a big problem. This is how big that could be. This is just impossible. It's very, very hard. So we're going to have to do perhaps another commercial simplification to this, because as stated, this is not something that can be done. 8 to the power of 1000 is more than the numbers we can store on the biggest hard drive on Earth. So it just won't work, right? But if there is a way to mathematize this and to create a Monte Carlo method to do some of these analysis, then that's what we would do. By the way, now that I've mentioned Monte Carlo several times, let me just write it here, because this is one of the lectures that's coming. Okay, I want to show to you how we can do Monte Carlo. And why. This is a very good example why. This credit matrix methodology, which is used everywhere, is something that cannot be done unless you make a Monte Carlo approximation to this simulation methodology, which is prescribed by the credit matrix method. Okay. Now, we're not going to see Monte Carlo in such a complex situation as this one. I'm just going to give you the basic Monte Carlo, but this is how it all starts. And finally, to remind everyone that this is a methodology that does not integrate market and credit risk. It's only credit. Remember, the value of my bond will change to get higher or lower as a function of my counterparty being upgraded or downgraded, not because of interest rates moving, for example. Okay. There are commercial solutions that take that into account also, but those are commercial solutions. And this is as far as I want to go with a commercial description of something related to credit. Okay. Okay. So this is the end of the credit matrix discussion. We have seen how mathematics of a certain type gets embedded into a commercial discussion, and the result is a prescriptive methodology that you implement and you believe the answers. If your regulators are happy with this methodology, you report it to them and move on. Any questions?
Yeah, I had a question regarding the indexes. Is there any reason why we chose, for example, banking index?
Oh, yeah, no. The prescription is, so I didn't choose anything. The prescription is that, let me just go there. The prescription is that you do the regression. And when you do the regression, you use everything, all the 200 indices.
Okay.
I'm just saying that if I did the regression, this is what I would come up with.
Okay, yeah.
Okay,
Yeah.
so the regression will be, who knows what amount of junk you're going to get in that regression. I'm just explaining that if I do the regression and my computer is very smart, it may give me the right thing, which would look like this. Another part of the prescription that is hard, as you said, how do you know that this is the right regression? Well, doing regressions is hard, especially when you have 200 variables, right? So you're going to have to very carefully consider the p-values, make sure they're very low, and this and that, the R-squares, and find the regression that you believe in before you move on. So this, I just gave you a very high-level summary of that. How to implement this, it requires a lot of other considerations. Good. Any other questions? No. All right, good. So in that case, what I want to do now is I'm going to change topics, and I'm not going to take a break. It's too early for another break. I think you can withstand another model. Okay. And now this model is completely different from the credit matrix model. On the one hand, there's a commercial version of it that we will see, but it is rooted on a big discovery that Robert Merton made in 1974. And maybe I want to start with that. because it's such a beautiful story. To explain this, I need to get you back to something we already saw in this course earlier, which is the history of the development of the Black-Scholes theory. Black and Scholes, Fisher Black and Myron Scholes at Stanford, they were looking at how to price stock options. And they came up with a very nice methodology to price stock options, and they showed this to Robert Merton at Harvard. I believe he was at Harvard at the time. And then, what happened there is I was not witness to that conversation, but it must have been a wonderful conversation. A result of which was that Scholes and Black published their results in a certain journal, which now is called the Black-Scholes theory. Some people like to call it the Black-Scholes-Merton theory because Merton at the time was working on the same problem, and he ended up finding a different methodology to the same solution, a different methodology, a different approach to that problem, which he published separately. And the interesting part is that in 1973, we knew how to price options. And what Merton was after, well, he was after many things. Merton, the motivation for Black and Scholes, as stated on their Nobel write-up, was to price stock options, which are used as part of the employee compensation packages. Okay, that seems to be what their motivation was. Merton may have had the same motivation, but Merton has something else in mind. And this is the interesting part, which is relevant for us today. Because Merton knew that if you could price options, then you can price credit. And today, what I'm going to show you right now is I'm going to show you how, with a Black-Scholes theory, we can price credit. Not only we can price credit, but we can redo everything we have done in the last lectures about credit, all in the context of the Black-Scholes-Merton theory. It is, in my opinion, fantastic. What we're about to see is a great construction, it's a great model. It's based on the Black-Scholes-Merton theory, but it is a very intelligent perspective to understand credit. So I'll start with this. I have a picture here for you, and the picture is how a company has its accounting set up. A company has assets and liabilities. A company has things that it owns, called assets, a thing that it owes, which are liabilities. And Merton's observation is that a default will occur when the value of the liabilities exceeds the value of the assets. Very simple. If, in fact, not only that, he would say that what is equity? Equity is, you can think of equity, typically equity is expressed as assets minus liabilities. And that is almost right, because it's missing one important consideration. Equity can never become negative by law. Okay? When companies were created with the governing law that we have for companies around the year 1700, during the Industrial Revolution, companies are allowed to be of limited liability. You don't have more liabilities than your assets. That means that equity can never become negative. So if equity can never become negative, to say that equity is assets minus liabilities is wrong. It's only true when assets are bigger than liabilities. When assets are less than liabilities, equity is zero, not negative. In other words, that is the same as saying that equity is an option, a call option on the assets of the firm with a strike price equal to the liability of the company. This changes everything. This is a fundamental observation that is going to help us rebuild the theories of credit from an option perspective, where we're going to be able to find the price of a bond the probability of default, and everything we have done so far. By the way, we're also going to be able to address one of the most elusive objects we have introduced, which is the loss given default or the recovery rate. Why? Because in this model, what is the recovery rate? The recovery rate is the value of the assets. That's what debt holders will get. So this model that I just presented to you not only has a very nice definition of default built into it, not only will allow us to price bonds as options, but also has built in a random recovery process. All of that from this picture on the right. So let's get to work. Let's get to model everything I just said. Okay, this is a fantastic cathedral to a human invention in my opinion. Okay, so let's talk about debt and equity of companies. Now, taking into account that both debt and equity are the options on assets. So, according to what I just said, I'm going to write this down in mathematical terms, and the value of the equity of a firm is going to be the value of the assets minus the liabilities when they're positive, 0 when they're negative. V is the assets, value of the assets at time t, and t is whenever I'm, say, in a year, if I want to do annual probabilities of default. Okay. K, I write it K because it's the typical notation we use for a strike price of companies, of options. So, but in this case, it denotes the future value of liabilities at time t. So this is the statement that we are using. And since the firm's assets equals equity plus bonds, I get a related formula for the value of my debt. A bond is going to be the value of the assets minus the value of the equity. The value of the equity is this option, and this is the same as to say that the value of my bond is the minimum value of the liabilities and the value of the assets. So if the assets are below liabilities, you are bankrupt, and the recovery rate is determined by the value of the assets. If the value of the assets is higher than the value of the debt, then the value of the debt is the price of the bond. So you see, this builds into it not only the default event, but also the recovery rate. And it expresses the value of the bond somehow as a put option on the value of the assets. So that's the asset value. That's the stock price and the bond price. That is stocks as a call option. See, this is very important because usually in the past we have seen options on stocks, but now we're seeing stocks as options on assets. Okay, and bonds are a short put option of some sort. Okay. All right. So this is the context for that. And now if I use the Merton-Black-Scholes formula, if I assume that the firm's assets follow geometric Brownian motion, which we've already been encountered with, where the value of the assets is an Ito process with a drift equal to a certain trend times V, obviously, and a certain volatility. And if we idealize everything, assuming that no transaction costs, including bankruptcy costs, so bankruptcy is for free, then we can price the value of the stock. This is a call option, so we know that the value of the call option under the Black-Scholes had a particular expression, and that is was given by something like that, where V is the value of the assets, N is a certain X is the cumulative distribution of the Gaussian, and then these two terms, D1 and D2, are given by explicit combinations of the value of the underlying and the liability and the strike price and this and that, which in our context is exactly what's written on the screen. So this is a long expression. Let me just go through that with some level of detail, because these things now have a very interesting meaning. Again, this is not new. We've seen this before. We saw this when we developed the Black-Scholes theory. We also saw it a few days ago in a different context. And now look at this. This term here is the value of the debt. That's the debt, the future value of the debt, divided by the value of the assets. What is that? Well, in accounting terms, that's called the firm leverage. Okay, highly levered firm owe a lot of money and they have few assets. So that's the firm leverage. The volatility everywhere, it scales to time, as we have seen with the square root of time, and the time is my horizon for default. And both this term and that term, they are fed into the cumulative distribution function of the Gaussian to get me the value of my Black-Scholes price. So this is all news. We've developed this in the past, but now it has a new found meaning because it defines default. Now, I want to make a comment about asset volatility. The difficulty in applying the Black-Scholes theory, as we have seen, is always in understanding what the volatility is, because volatility from an Ito perspective changes very slowly. It's an Ito process. However, in the market, if you look at the volatility in the market, it changes very fast. We saw the concept of implied volatility and this and that. We've encountered that already. But now, here, volatility is even worse in the sense that we have even less command over it because it's the volatility of an asset. An asset does not trade in the market. Assets are calculated by accounting firms quarterly and audited annually. There is very little information about the asset value, even just the value. So to calculate the asset volatility is even more complicated. So how can we do that? Well, we're going to have to resort to almost a trick to understand what the asset volatility is. Okay, so in practice, equity volatility is observed. You observe that from option prices, you observe that from market behavior, but not asset volatility. So for that, what we're going to do is we're going to derive it as follows. Because a stock price is an option on the assets, I can see from the Ito expression that the evolution of the stock price is the delta times the evolution of the asset price. And the delta is the partial derivative of the option with respect to the underlying, which is in this case is the asset value. And from here, if we go to the stochastic terms that enter into the geometric Brownian motion expression for V, where I get is that this expression must be satisfied between that links the volatility of the stock with the volatility of the assets. One could think, but it's not true, one could think that it gives me a value for the volatility of the assets. The volatility of the assets from the previous expression should be equal to the volatility of the stock, which I know, times the value of the equity, which I can calculate, divided by the value of the assets, which I know, times the delta of that option, which I can calculate. That is true. But note, this is very important, note that this is a function of the volatility of the assets, because the volatility of the assets is part of the Black-Scholes theory. We need the volatility of the assets to calculate the terms on the right-hand side. So this is not an equation, or if you like, it is an equation, but it's not an equation that determines explicitly sigma V, the volatility of the assets. This is an equation that determines implicitly the volatility of the assets. In other words, if you give me a number, sigma V, that I use to calculate the thing on the right, and gives me the same number as the number you gave me, then that is the volatility of the assets. But if the calculation from the right and from the left are different, that is not the value of the assets. That's not the volatility of the assets. Okay? That's the way this has to be understood. Now, mathematicians have a term for this, and this is called a fixed point. It's a fixed point because it's something that if you plug it in here, you get the same value as the number you plugged in. the theory, the mathematical theory of fixed points is very developed. We know a lot of things about fixed points, and this is one which is particularly simple. And there is an algorithm to calculate this, which I will show you. Okay, but I want you to understand that the calculation of the volatility of the assets is one of the difficult stumbling blocks for the Merton model. Okay. All right. So to explain this, what I am going to do here is I'm going to show you how I would calculate the volatility of the assets of the Goodrich in the year 2000. I went to the year 2000. I could not go back to the year 1980 something because I could not get the data. I was able to get the data from the U.S. From the Securities and Exchange Commission. I could not go all the way back, but doesn't matter. Okay, I will recreate this for you. I want to show you how we can calculate the value of the assets using the Black-Scholes theory, the volatility of the assets. Okay, so from the company financials, I can get the book value of the assets, which is $7 billion. And this is just the accounting statement. You just look it up, right? You look at the book value of the liabilities at $4 billion. Again, you just look it up, okay? So these are numbers which are in the company financial. You just look them up. You don't have to calculate anything, just look them up or ask ChatGPT, it doesn't matter. You can also see that there's 102 million shares outstanding, okay? So that allows me to calculate the price per share. And now from the New York Stock Exchange, what I can see is that the stock volatility is about 50%. I just calculate that using whichever you preferred method. I can see that the share price was $32. The day I was calculating this, doesn't matter. Again, it's not 1983, it doesn't matter, okay? And then what I do is I calculate, on the one hand, the book values for everything that I'm looking at. The book value for my equity is value of the assets minus value of the liabilities, which is $3.6 billion. That's the book value of the equity. It's not the actual equity value. The equity value has to be slightly higher because it's an option on this, right? Okay. So the future debt, which is at rates of 3%, we can see that the future value of the debt is the $4 billion growing at a rate of 3% in a year is $4.12 billion. And then when I look at the market values, I can see that the stock price is $3.286 billion. That's the market price. That's the market price of the stock. Okay, it's not the value of the equity; it's the market price of the stock. Now, note one thing here: the market value of the stock is less than the book value of the stock. What does that mean? Is that
The company's undervalued.
sorry?
That's if something is undervalued.
I cannot hear you. It's a random value, did you say?
That the company's undervalued.
Yeah, that's right. The company is undervalued. That's the company is undervalued. So if you were, for example, a value investor, you would be looking at this company and say, well, this is a target for me to buy it because it's been sold under book value. But of course, when you do that, value investors are very smart. They know that perhaps those assets are overvalued. That's also possible, right? Who knows in those assets if you have you have to go look through the company financials. So that's what investors do. They go through the company financials and say, yes, it's true. The value of this, contract is, $500 million, but that's assuming that this supplier sells at this price or that that. So they have a way of adjusting that. So the company is undervalued from that perspective. It is unusual, but it happens. It may trigger a buy order for a value investor. It may actually indicate that there's something wrong with the situation. That is not a concern for us. It's not a concern for us. Okay, it's not a concern for us because we are just aiming to calculate the probability of default of this company. So to do that, this is what I'm going to do. I'm going to do the iterating of the asset volatility as per indication by mathematicians. That's how mathematicians like to find fixed points of things. And there, what I'm going to do is I'm going to introduce a number of variables. I'm going to introduce the interest rate variable called R. I'm going to introduce the underlying price of the assets called V. I'm going to use the time to maturity denoted by T. I'm going to the exercise, which is the value of the liabilities, denoted by K. I'm going to use the stock volatility sigma S, which we know is 50%. I'm going to use the asset volatility, which I don't know what it is. That's my unknown, but I want to call it sigma A. And then I'll use the option price, which is the true value of the equity. It's not the stock value of the equity, and it's not asset minus liabilities. It's the value of the option, as Merton prescribed. That's the option price. Then the delta is the derivative of the option price with respect to the asset, which is the underlying. And the fixed point is the quantity that I want to calculate. And what we need is the fixed point number to be the same as the asset volatility. When the fixed point, when the last cell is the same as the asset volatility, we know we have the asset volatility. We know we have the answer. Okay, so this is what I'm going to do. I'm going to iterate this through time. I'm going to use the market values. The market values in my first iteration is the interest rate is 3, the underlying price is 7.7, time to maturity is 1 year. Exercise price is 4.1. Remember, that was the future value of liabilities. We calculated that earlier. The stock volatility, I'm taking 50%. The asset volatility, I don't know, so I'm going to guess. I want to put just the number there, 50%. Yes? That's how I start this, and then you get your option calculator. We saw one, we used one, in fact, a couple of days ago. And you get your option calculator, and then you calculate the values that we have here. With your option calculator, we get that the option price is 3.8. We get that the delta is 0.94, and the expression that should give us the fixed point is 26.47%. This is just using the black source calculator. Okay, so this is how my iteration works, right? Do you understand that? So what we conclude from here is that the asset volatility is not 50%. We made a guess of 50%, but it's not 50%. Why? Because 50% was supposed to be equal to 26.47%, and they're not. But we do not despair. What we do is we go to the next iteration, and I use the interest rate the same, 3%. I use the market value, 7.7 is the same. It's the market value of the underlying. That's the assets, the company financials. I'm not going to change that. Time to maturity continues to be a year. Exercise price continues to be 4.1. The stock volatility is the same, it's 50%, but now I'm going to change the asset volatility. And instead of 50, what I'm going to take is I'm going to take 26.47%. Why? Because mathematicians told me that if you're looking for a fixed point, you iterate. And that's what I'm doing. I got the wrong answer. I'll put the wrong answer into my asset volatility. See what happens. When I do that, I see that I use my options calculator, and I get that my option price is 3.72. I get my delta close to 1, and I get my fixed point to be my fixed point expression to be 24.27. You see, it's getting closer now. It's getting closer. In fact, if I go now into the next iteration, I can see that I get the same. So from here, what I derive is that the asset volatility for Goodrich is 24.2%, the asset volatility. And I've done this without a historical time series for the assets. This is the asset volatility as implied by the Merton model. Truly wonderful. Let's pause and catch our breath. This is a high moment in this course. We've achieved something remarkable. But this is just the beginning, because now that I have the asset volatility, this unlocks many things that I can do. It unlocks many calculations that I can do, because now I can use the Merton model in its full force to calculate anything I need. Okay? I have the option price, which gives me the value of the asset according to the Merton model, 3.72. All right. So from here we can draw a number of considerations. First is I want to talk about the value of the limited liability provision. If I look at the market price of the stock is 3.286, we saw that it's undervalued. We saw that the book value of the equity is 3.6, and we saw that the option value is 2.722. So from here, what we conclude is that in the case of Woodridge, and in this particular case, the value of the limited liability provision is about $100 million. Is some of the good things we can derive from this model, okay? And this we obtain by comparing the book value of the equity minus the future liabilities with the option value. And again, yes, the stock is undervalued in the market. Okay, so these are things that we just get because of this, in my opinion, very original perspective of Robert Merton and the way he looks at companies. You know. Okay, so in case you have not seen a fixed point is a map that goes from one space into the same space, and you're looking for the one point that is just constant after. That's what we have done. We have implemented in a financial context what mathematicians have done for hundreds of years in their quest for fixed points. Okay, great. Now, so let me now move forward, and I'm going to use the Black-Scholes theory in the context of the Merton model to price the debt of a company. Since the value of the bond is given by the value of the assets minus the equity, I can use the Black-Scholes theory to price the value of the bond using the Black-Scholes theory. So we see these terms which we are now familiar with, these two companion quantities arising from the cumulative distribution function of the Gaussian. We see the discount factor, we see the strike price, which is the value of the future equity, and this and that. So from this, what we get is that we get this expression, which is that the value of the bond, this is a default-prone bond, divided by the riskless value of the bond, which is the value discounted future liabilities, is equal to what? Is equal to this quantity we have here, of which I will say something in a minute, plus that. In other words, the value of the bond is a little bit bigger than that. Now, what does that mean? Where is that coming from? Well, I tell you one thing that we saw a while ago, a long time ago, which is the Black-Scholes theory tells us that this ND2, this number, is the probability of exercising the call. It just comes from the Black-Scholes theory. When do we exercise the call? We exercise the call when the bond does not default. In other words, this is the probability of solvency. Okay, it's the probability of solvency. So what this says is, this is a miracle, and I need to describe this to you in great detail, because what that says is that this quantity, which for us was, I remind you, when we started to look at credit risk, this for us was e to the minus r plus h times, that's what it was, okay? And then we saw that this was very close. If you divide that by the riskless, which is that, what we get is something very close to h. We saw that, very close to the probability of default. That's what we saw. But then this says that it's bigger than that. It's the probability of default plus that. Why does the Merton model give me a higher value for my bond than this approximated probability of default that we saw at the beginning of our credit lecture? Why? And the reason is that the Merton model has built in stochastic recovery. Of course, the value of the bond is going to be higher. In fact, this is the value of recovery. You see, the Merton model does not need to treat recovery differently. It's already built into the model. And the adjustments are given to you like that. I call this a miracle. It's fantastic. Fantastic. Let me move on because there's another miracle coming up. This is miracle number 2. Let me calculate now the expected credit loss. The expected credit loss will be the value of my risk-free bond minus my risky bond, just the difference. So I have that. Let me just express that. I'm going to do some magic passes. I don't want to go through. I know that there's a lot of variables here, but these are the variables we have seen all throughout the day today. And I have that, which happens to be what? Let's just look at that in some detail. This is the probability of not exercising the call. In other words, it's the probability that the bond will default. That is the present value of the bond. That's the exposure, so to speak. And what is that? That's the present value of the expected value of the firm in the case of default. So the expected credit loss is what? Is the probability of default times exposure times something else, which comes from the stochastic recovery. Again, see, we saw in a previous lecture that the expected credit loss was the multiplication of 3 things. And then we saw, well, maybe we can assume they're independent, and then I get a number, and say, well, maybe I assume they're not independent, and then we get a different number, and you did, yourselves, you did a problem to solve that in the case of Kutaisi. Merton does it differently. He doesn't need all of those considerations because everything is a function of the Black-Scholes price. But the structure is the same. It's probability of default times the value of the bond times something else, some correction factor from the stochastic recovery. Fantastic. Okay, so this is miracle number 2. Fantastic. This theory is just wonderful. Now, so the theory is wonderful, absolutely wonderful. And not only wonderful, we can make it work. So far, we've made everything work. Every number we have on the screen, every number we have had on the screen is something we can calculate. The most difficult one was the volatilities of the assets, but we already found them. We already, in fact, developed the algorithm for that. So what else is there? What else is there to do? Not really very much, but what I want to do now is I want to tell you about a commercial version of this, which was done by K, M, and V. McEwen, McNeil, and Vasicek, I believe. Sorry, I forgot the names. They're coming up, okay? So this is 3 people that took this context of the Merton model and then made a commercially viable version, okay, which we're about to see. It's going to become a very, very simple variation of what we have seen so far. Okay, so it all starts with the following observation. So we're about to make things a lot easier. If I look at a company has asset values equal to whatever number, we observed that today, and then we don't know what these asset values will be in the future. But we do know that the company has a certain liabilities, which are represented by that. So default will happen when the value of the assets gets that low. If the value of the assets stays above it, the company does not default. If the value of the assets gets below that, then the company will default. Okay? So this is the context. It's very easy to do. And in fact, to find the probability that I hit the default point is very simple. Very simple. How do I do that? If I say that this is a Gaussian distribution, then this becomes a quantile. So why not adopt that point of view? It's a simplified version. Why not adopt that? And if you adopt that, then suddenly The methodology to calculate the probability of default is very simple. I'm going to do this in the context of a problem. I'm going to do now a number of problems, and then we'll finish my lecture for today. So the KMV credit risk model generates an estimated default frequency based on the distance between the current value of the assets and the book value of the liabilities. That's how these things are done. And if so, I'll continue with the statement of this problem because everything we are ready to understand all of this. If the current value of the firm's assets and the book value of the liabilities is $500 million and $300 million respectively, if I assume the standard deviation of returns of the assets is 100 million, what is the probability of default for this firm? So one observation. This is the hard part, but they already give it to you. You don't have to calculate it. So then what I do is very simple. Is I just take I take 500 minus 300, divide by 100, and I get 2. All the numbers are given to me in the statement of the problem. And then I calculate the quantile function for 2 for the Gaussian model, and I get a 2.3% probability of default. Okay. So this is the picture that summarizes how we do the calculation of the probabilities of default under the Merton model. Is the KMV and the probability is given by the cumulative distribution Gaussian, the cumulative distribution function of the Gaussian. This is a very interesting company that was created. KMV was a company that was doing essentially these types of things for companies, and their business model was as follows. Companies went to them and they basically gave them their data so they could calculate their probabilities of default. You can get the transaction probabilities. With this model, you can calculate anything. And they were doing that for thousands of companies. Or actually, they had thousands of data points that they collected from companies. And whether you like this model or not, at the end of a few years, they had a very, very interesting database of companies. And Moody's bought them for, I don't know how much money, I think it was, I forgot. Moody's bought them, and the reason they bought them is because of their data. The data had collected from companies, because as you collect data from companies and you track the companies, then you can improve your model. And this has been adopted by Moody's as their way to do credit calculations. So at the end of today, what we have is we have 2 perspectives on credit. One commercial done by JP Morgan in 1997, and one done shortly after by KMV, implementing these variants of the Merton model. The approach is very different. Creditmetrics uses bond prices. KMV uses stock accounting information. They both give us the same answers. They tell us probabilities of default. They tell us the evolution of these things over time. As you can see, this is a model that can be extended over time. They give us bond prices, one using spreads and the other one using risk neutral probabilities. Okay. And these are 2 of the main used credit models today. Okay, so I think with that, that's all I was going to tell you today. I finished early, so you can take some time off. And this also ends my discussion on credit.